Today, most of the investors invest just based on some trends, tips, or maybe vibes. In this video, I'm going to show you a completely different way, a structured and data driven approach of analyzing or looking into your stock. Then, I'm also going to show you how, with the help of AI, I am analyzing the stocks that earlier used to take me days in just few minutes. So, this video is broken into two parts. In part 1, I'll be discussing the exact framework which I'm using to deep dive into the stock, and in the part 2 we'll be discussing some macroeconomic themes based on the current geopolitical, geoeconomic scenario, government spending, what are the key themes or sectors where we see good growth in next 2-3 years and where we should be parking our money in. So let's get started. So let's start with the first part. So before I buy any stock or even think about it, I run it through a 3-layer check, which is basically the fundamental durability of the business, the valuations of the business, and the current momentum of that stock. Let's break each one down. First is fundamental durability. Here I want to understand how strong the business is. It should not be a temporarily strong business, it should be fundamentally strong in its operations. So to check that, I generally look into 3 things: the profitability of the business, the current debt structure of the business, and specifically the growth factor of the business. So to check about the profitability, it's important that we look into multiple profitability ratios. These are some of the specific ratios which we want to look into. The first one is the net sales or the overall total revenue of the business. The current revenue of the business should be increasing in last 2-3 years. So the fundamental rule is the projected revenue or the revenue of this year should be greater than the revenue of the last year. Second is we want to look at the net profit of the business. So here also we have to make sure the current year net profit is greater than the last year net profit. Then we'll be looking at the earning per share trend, which is this also should be signaling a growing momentum. The earning per share should be increasing year on year. So we'll have to check how the earning per share has improved, and if it is increasing, it's a positive sign. Then we'll be finally looking at return on equity and return on capital. Now the general rule says that for any company, the return on equity and return on capital should be greater than 12%, 10 to 12%, because which is basically your average growth rate of the market. So if the company's earnings are greater than that, it's a good sign generally. So we'll check into ROE and ROCE. Now here one thing which we want to make sure is that we don't look these things in silos. Every ratio which we are looking at has to be looked relative to the performance of the competitors. For example, 20% earning could be a good signal in banking, but it could be a very strong signal in commodity business. So we have to understand how the relatives are performing. If the competitors are performing at 15-16% of ROE, ROCE, and our company is giving us 20-25% ROE, then it's a good signal. While if the company is giving less than 15%, which is the average industry benchmark, then potentially it's a negative sign. Then coming to the second part, which is your debt and durability of the business. So in the debt scenario, we check about the D by E, which is debt to equity ratio, which is basically how much debt has company taken relative to its equity. Here the general rule is debt to equity ratio should be less than 1 for any company. If it is more than 1, then generally it means that the company has taken higher debts, and which in return will result in higher interest payments and higher cost for the business. So D by E should be ideally less than 0.5, 0.4, which is a good signal. And then finally, we will be, to understand the overall fundamentals of the company, we will be looking at the growth factor. Now to look at these, we generally have the growth factor indicates what is the specific growth projections of the company. If the growth factor is greater than 5 or 6, it is generally a good signal. Apart from this, we also look at promoters pledging, which is how much percentage of the shares are being pledged by the promoters. If the promoters are pledging higher proportion of their equity in the business, it means they require cash, and it's a red sign, it's a red flag for the business. So this gives us a general idea about the overall fundamentals of the business. Now, after profitability and fundamentals of the business, we want to check the valuation of the business. Even the best businesses can be bad investments if we overpay for it. So it is very important to understand whether the business is valued rightly or not, whether it is rightly valued, overvalued or undervalued. Our motive is to figure out which are the undervalued business, because they are going to get right value in the future and they are going to appreciate, and exit the overvalued businesses from our portfolio. Now, to check the valuation of the business, again we'll be looking at some of the ratios relative to the competitors. It is very important, whatever we are looking, we look in terms of what competitors are doing in the same industry, how they are performing, and then based on that take a decision. So the first valuation ratio is price to earning ratio. Now, price to earning ratio is basically what is the current market price of that share divided by the earning per share of that company. Now, if the PE is, here we see the relative PE of the competitors. If your PE is greater than the average or median of the industry, then the company is overvalued, while if PE is lower than the average, it means it is undervalued. Here also there might be some companies who are fundamentally very strong and their PEs are on the higher side because there is some premium moat which is built in that company, because of which they are driving in that PE range. So that is something which, that is the call which we have to take, whether the PE is right or wrong. It should not be too off, but to some extent we can consider the premium PE if we understand that the fundamentals of the business are so strong, or the moat of the business is so strong, that in long run we'll be getting that value of that premium PE which we are paying right now. The second is price to book ratio, which is basically the current market value of the share divided by the actual book value or the asset value of the firm. So how much worth the company is on its books based on the total valuation of its assets. Here also we compare it with the competitors and check if the PE ratio is below the average or the median, then it's a good sign. If it's on the higher side, then it's a red flag that the company is overvalued. And finally comes the PEG ratio or PEG ratio, which indicates the growth prospects of the company. So if PEG is less than 1, it means there is a potential for growth of the company in the coming future, in the next year, while if PEG is more than 1, then it means that the company is overvalued and it will not grow in the next year. Formula of PEG is simple: PE divided by the earnings growth, like EPS growth over the last 5 years. So after analyzing the durability and valuation of the company, we create this 2x2 verdict matrix, which gives us these 4 scenarios. The first one is the company has strong fundamentals but is undervalued, which gives us the signal that we should be buying this stock, but here we will not be buying it. There's one step which is pending, we'll discuss it, but let's discuss this matrix first. The second scenario is the company has strong fundamentals and rightly valued. It gives us the signal to hold or add in a paced manner. We don't have to buy in bulk, but we can start our SIP or make additions, buy during dips. Then the third scenario is strong fundamentals and overvalued. Here we need to book our profits to some extent because the company will see a downfall or a downtrend in coming future to get it rightly valued. And the fourth one is overvalued and weak fundamentals, or weak fundamentals or any valuations. Here since the fundamentals are not good, it is better to avoid these kind of companies. We will not take positions in the company where fundamentals are bad. So once we create that 4x4 verdict matrix and we have the directions what we want to do with the stocks, there is one more step or one more check which we want to ensure, so that which is basically the momentum or the technical check of the stock. So I'm not a trader and will not be going into very deep technical analysis of the stock. However, it is very important to understand what is the momentum of the stock, whether it is trending in the upward direction, sideways or downwards, because even a good fundamental stock, if it is trending downwards, then there's no point in buying that stock and making positions. It's better to wait till the time the cycle changes and the stock starts trending upwards. So a basic check of the chart we'll be looking at, and we'll be looking into basically long run and short term. For short term, we'll be looking at the charts of 6 months to 1 year, and for long run this would be more than 1 year, specifically 1 year to 2 years chart. And if the stock is fundamentally strong, undervalued and is on the upward trend, that gives you the signal that you have to buy. While if a stock is trending downwards, it's better not to invest your money in this stock right now, because any downward trends goes for a period of 9 months to 1.5 years. So it's better to wait, see when the trend reverses, and then after breakouts we start investing. So after all these 3 checks, we finally arrive at one of these 4 actions, which is number 1, buy or add. The second one is hold and monitor. The third one is reduce your position or book profits, and the fourth one is exit completely. Every decision has a logical step to it. It is not based on emotions or the vibes, it's based on what the data is showing us. Now, as we have understood the framework of analyzing the stock, we'll see how using AI this entire process can be done in few clicks and prompts. Earlier, for which it used to take me hours and days, entire weekends to complete that research, now it can be done with just few prompts. This is honestly, I'm amazed how AI is gonna shape our future. Just think of it as like having a well-read investment banking buy-side analyst who is sitting next to you, who can read and synthesize data much faster than you can. It's not like we are using Claude for stock tips. It's like we are using it as a research partner. So if you see my screen, you can see that this is the prompt which we are going to share on the with the Claude, that I want to analyze the company name stock. So this is the prompt which will give to this Claude. I want to analyze dash and dash stock. I want a full breakdown covering fundamental analysis using profitability ratios, the ratios which we discussed earlier, valuation ratios compared to peers, and finally debt ratios and the technical momentum of the stock. Use data from screener.in and trendline. Tag the stock by industry, sector, theme and market cap. Tell me if it is a buy, hold, reduce or exit. Notice what I am doing here is I am not asking Claude for a tip. I am asking it to structurally research for me. The framework is mine, the thought process is mine. Claude is just executing as an agent what I am telling him to do. So it is working as a buy analyst for me. So this is where it gets interesting. Claude has a live web search feature, so it is able to do a live search on the web and pull out the stock prices, current trends, current news about and current fundamentals of the business from websites like Screener and Trendline. It checks the recent news, recent developments in the company, and then based on that it gives us a structured output. It is also citing every source so that we can verify, and whether we want to trust that information or not, it is on us based on the source it is providing. So you can see the result. It is amazing, right? The Claude has now given the analysis of the entire stock based on what we asked it to do. breaking down into a specific industry sector theme categorization, and then giving us the profitability valuation and the momentum scores for the stock. There is, even you can download your Zerodha or like stock reports, feed it into Claude and ask it for the analysis whether the stock is performing good or not. It will give you the entire analysis. So I think AI is gonna help us a lot. It is going to improve our efficiency a lot. It depends on how efficiently we are using that. While we are using Claude, it is very important that we understand that since it's an AI, it has some limitations. It is just a research tool, so we have to understand what AI can do and cannot do. So this is a table which I have made. Just read it through, that what we can expect from Claude or any other AI versus what we cannot. So AIs can pull live financial data from public sources, but it cannot access your Zerodha or any broker account directly. Compare stock to sector peers or ratio, but it cannot predict the future prices. So figuring out what would be the target or what would be the support prices, that is something which we should take the decision based on our analysis and should not depend on what the software is telling us. Summarize recent news and quarterly research, but cannot give SEBI registered investment advice. So just investing based on what the AI is suggesting is not recommended at all. It's better to take it help as from a research point of view, but do your own analysis, make your own logical deductions, and then invest into a stock. Now, as we have understood that how to analyze a particular stock through the 3-layered framework of fundamental, valuation and momentum, and we know how to use AI to specifically do research for us, it is also important to understand now what are the major or hot themes which will be relevant for the next 2 to 3 years where we shall be investing our money. Now, while I want to discuss opportunities or the themes which will be prominent in India, I want to emphasize on one point that in the current scenario, it becomes very important to even diversify our money outside India. So for example, if I talk about Sensex or the Indian stock market, it has been flat since last 2 years and there has been net zero returns. It becomes important that the markets which are growing outside India, we invest a small proportion of our money there. Now for beginners, it's where do we invest? The question arises, what should be the investment outside India, in which niche? So the simple answer is, we know AI is the next big thing, right? Most of the AI companies are from USA. So we can directly invest into tech companies of USA. That would be adequate for your foreign portfolio investments. You don't need to invest into multiple countries, into stock markets of multiple countries, multiple sectors. Even if you invest a small portion of your portfolio in US stocks, I think that gives you a good exposure or to foreign growth, because USA is the largest market in the world. The AI boom is coming from USA. Most of the companies are US based. So even if we invest in tech stocks of US, that should give you good returns. Now in this video, we will not be discussing on how we can invest in US stocks. If you want that, just comment down in the video. I can make a separate video discussing on all the ways of investing, doing foreign investing. I want to get back into what are the major themes which will be important for the Indian growth story. So we have been hearing from last few years that this is the decade, or these are the decades of Indian growth. India is the next big story, and we have also seen that in our stock market over the last decade. We have seen good growth, but currently, since last 2 to 3 years, the stock market has not been performing that well. It's a cyclical thing. It doesn't mean that the Indian story is over. Indian story is still intact, and we should be prepared for the next wave of bull run where we shall be investing. So for that, it becomes very important to understand what are the major big themes where we shall be parking our money. So what are the major themes of India will be decided based on these three factors: RBI's monetary policy, the geopolitical landscape of the country, and then the government spending priorities. RBI's policy gives us the indicator where the Central Bank of India or the Reserve Bank of India wants the flow of the money to be in. What are the sectors where the government, which are important for the growth of the economy, where the Reserve Bank of India wants the money to flow in. The government spending priority gives us the indication of what is the priority of the government, what are the sectors where government will be putting in a lot of money to maintain that higher growth rate, Indian economic growth rate. And then finally, the overall geopolitical landscape. A lot of things are happening around us. There's a war going on in Middle East that is impacting a lot of industry. Then there is tariffs going on. So all these are going to impact on how the macroeconomic environment of the India changes, and that impacts what are the sectors or the industries which are going to see growth. Now, one of the first theme which I want to say is the defense and aerospace. There has been a major push from the government side in terms of increasing our defense budget. So the defense budget for this year has crossed 6.8 lakh crore rupees, which is a 10% rise from last year. We are seeing a lot of buzz around self-reliance in defense. We are incentivizing these sectors to ensure country's self-reliance in defense manufacturing and exports as well. So this is definitely, aerospace and defense is definitely one of the prominent sector which is going to see a growth in future. Government is backing this sector. The current macroeconomic or geopolitical environment, there's a war going on in Middle East. We had altercations with Pakistan in May 2025. So what all these indicate that our defense priorities are going to increase. So this is a good opportunity to invest in that area. The theme 2 is infrastructure and capital goods. So this has been the major focus area of the current government. Transport infrastructure alone is getting around 6 lakh crore rupees in current year's budget, covering roads, railways, ports, airports and urban metro projects. When government spends this aggressively on infrastructure projects, it creates a cascading impact or opportunity for capital goods and industries like cement, steel, engineering services, etc. So this is the other second theme, infrastructure and capital goods. We can think about engineering, procurement, construction related industries, park our money there, ports, logistics, railways, etc. The third theme which I want to discuss is basically the financialization of savings. So India's saving to investment journey is still in very early stage. We have been a country of savers. We have from our traditional times we have understood that we need to save to build wealth, but now we are moving from that we are moving from savings to investment. And in the recent years we have seen that growth. So if I talk about the demat account growths, they have grown from 4 crores to more than 4 crores in 2019 to more than 17 crores in 2026. If I talk about the insurance penetration, it is still around 3 to 4%, which is way beyond the average 6 to 7% in other countries. Mutual funds AUM has been growing, so we are moving towards that investment. We are moving towards the area where more and more investments are going to come into picture, and all the companies, all the industries which fall into this bucket becomes a good opportunity to invest in. This includes sectors like your stock exchanges and market infrastructure, capital market infrastructure. your asset management companies, insurance companies, your wealth management platforms, the entire supply chain or operations network which facilitate this entire process. For example, your depositors and registrars, these becomes your next good theme to invest in. Now another thing is energy transition and renewables. So we have committed like 500 gigawatt of renewable energy capacity by 2030, and government has been actively promoting schemes to promote renewable energy. This includes subsectors like solar power, wind energy, green hydrogen, power transmissions, battery storage, electrical vehicles, etc. So this is another sector which is going to see a boom. And then finally, I talked about tech companies outside India, but there is a scope of tech within India itself. You must have realized that India is going to be a next big destination for data centers. There's a lot of work going on in building data centers backing these AI companies. So that is something which will see a good boom in India. Figuring out which companies will be the major drivers of these data centers, data collaborators, is another opportunity which we should be thinking about. And finally, if I talk about few more themes, your healthcare and pharma, the budget adds 10,000 medical colleges seats per year. India's domestic pharmaceutical market is growing at 10 to 12% annually. So the sectors or the areas which generic drug export remain a key revenue stream for us. So the areas which we are focus here are hospitals and diagnostic chains, medical devices, API manufacturers. And finally, the ultimate digital India and technology mission. The budget allocates around like more than 74,000 crore to IT and telecom. We are building products like UPI, Aadhaar, ONDC, account aggregation, based on which many businesses are being built. The government is extending broadband connectivity to all secondary schools and rural health centers. So fintech is another sector which is going to see a great boom. So yeah, I'll now quickly summarize what we discussed today. We specifically discussed three things. The first part was how do we analyze a particular stock with a 3-layer framework, which is basically analyzing their durability of the business, the current valuation, and the current momentum of the stock. Then we learned how we can use Claude to do the research work for us with a few prompts. This saves us a lot of time and gives us quick decisions to make, do frequent changes in our portfolio to get the maximum ROI. And finally, we discussed the major themes or the hot sectors which are going to see good growth in the coming years. If you find this video useful, do like this, share it with your friends, and subscribe the channel if not already. This really helps the channel to grow. Please comment down the macroeconomic theme which you think is going to be the biggest growth driver for our economy in the next 5 to 6 years. Also, drop a comment for any macroeconomic or any topic which you want a video in. I read all the comments. I appreciate all your suggestions. Thank you for watching this video. I'll see you in the next video.